Welcome to Inside Economics. I'm Mark Zandi, the chief economist of Moody's Analytics, and I'm joined by my two co-hosts, Ryan Sweet, director of real-time economics, and Chris Dorides, Dr. Dorides, deputy chief economist. And Chris, you're now speaking to us from Denver, I see. All right,
I
here.
am. Yeah. Yeah. First conference since the first live conference for me since the pandemic. So
And who are you speaking to?
interesting. Oh, it's the National Multifamily Housing Council. So apartment researchers or investors, people interested in apartment markets around the U.S.
How are they feeling about things?
Um, I think kind of in line with everyone else, seeing things perhaps slowing down, but they remain quite optimistic when it comes to apartment demand. They see a lot of demographic demand out there, so some slowing maybe in prices, but they're not looking for a collapse anytime
Yeah.
soon.
I guess with mortgage rates rising and affordability getting crushed, that would help demand, right? All
That
else being
actually,
equal.
yeah, people can't buy homes; they have to rent. So
Right. Yeah, a lot going on in that market for sure.
yeah,
Any discussion around the uh, rental evictions and all of that controversy, or is that kind of faded away from the
yeah,
discussion?
that wasn't certainly
Wasn't even
top of
on
mind.
top of
Uh,
mind. Okay.
no, no.
Yeah. Okay.
Lots of
Good.
discussion around rent increases, right? And the explosive growth that we've had in rent increases over last year, 13, 14% year over year for new leases. And how sustainable is that, right? How can that really go on?
That sounds like a podcast. We
Oh yeah,
should
for
we
sure,
should
for
definitely
sure.
we should actually
We should,
we haven't done that. We should definitely do that. Maybe we'll get some of the
we could,
folks there that
yeah,
were. Yeah, that's a great
yeah,
idea. Okay, good.
yeah. They're all big fans of the
And
podcast, by the way.
pardon me.
Lots of fans of the podcast here, so
I'm
I'm
sure
sure
they're
they.
fans of mine, right? For
Yeah, yeah,
yeah.
absolutely. Groupies,
You
yeah.
guys too? Or really? Okay.
Uh, Ryan Sweet came up a couple times,
Oh,
right?
No,
You
no,
know.
that's
damn
never good.
Ryan. Yeah. Right. No, no, no. Uh, this has been a year. We've been doing this for an entire year. This is our 1 year anniversary. So
Hmm.
highly a lot of fun for sure. I think people can tell that from the conversation. But I think highly successful. I can't remember this. Do you guys know the statistics on how many downloads or any of that kind of stuff?
Isn't it like 500,000?
Is it 500,000? Really? Wow, boy,
I
that
could be off.
that
I don't
feels
know.
good. Yeah,
I
it
think
sounds
that's
like
what
a good
Sarah
number.
put in her email.
Okay, all right. And Ryan, have you made your way back into the office yet? I actually went into the office this week for the first time in quite a while.
I heard that you were there.
Oh,
And no, I haven't
really?
made it back yet. I might go next week. I think that's when the office officially opens. So
Officially opens just in
maybe we
time
should
for the
do our
next.
podcast all together in the conference room.
Yeah, there,
That would be
there you go.
fun. Yeah, just in time for the next wave of this thing, though. It feels
Yeah,
like.
probably.
Yeah, right. Good. And we have a guest, Michael Strain. Michael, good to see you. How are you?
I'm well. Thank you for having me.
Oh yeah, it's a pleasure. And Michael is the director of research at the American Enterprise Institute. Is that the right title? Director of research, of economic research,
Director of Economic Studies.
economic studies. Great, good. And so good to have you because we're going to talk about the economy. We're going to talk about what feels like has come to the fore in the discussion, the broad discussion around recession and recession risk. That just seems to have come out of nowhere. We're always hand wringing about recession, but the odds of recession seem to have risen quite a bit here. So we're very lucky to have you on to be able to help us kind of navigate through that discussion. But before we do that, can you, Michael, give us a little bit of a sense of AEI, the organization, the institution, and you, just a little bit about your background and how you got to be director of economic studies?
Yes, I'd be happy to. AEI is a think tank. That term, I think, should be retired because it applies to such a broad range of institutions that it almost has no content. But AEI is over 80 years old and is one of the older think tanks, and so still follows the university without students model that is also followed by the Brookings Institution and the Peterson Institute and organizations like that. AEI has researchers and experts in a really wide variety of different fields. We're very large as think tanks or public policy research institutes go. Experts on foreign affairs, experts on education policy, experts on public opinion studies, experts on defense issues, and of course, experts on all areas of economics. We are a nonpartisan organization, but I think it's accurate to characterize us as a center-right organization. Our economists are, generally disposed to free markets, concerned about economic opportunity, things of that nature. As the kind of policy and political landscape on the right has changed rapidly, that's been an interesting time to kind of be in this world.
Yeah, for sure.
As for me personally, I am an economist. My PhD is from Cornell, and
We won't hold that against you, Michael.
I spent some time at the New York Fed and some time at the Census Bureau. Came here to AEI as an economist, and then I was demoted into an administrative role.
I didn't realize you were at the Census Bureau. What did you do at the Census Bureau?
I was at the Census Bureau, but yeah, I was. I worked for the Longitudinal Employer Household Dynamics Program,
Right.
and then I was also the administrator of the New York Census Research Data Center that's located in New York. So that prepared me for my current role. I had to make sure that the carpets were cleaned, and make sure the trash cans were emptied, and make sure nobody was bringing a camera into the secure room, that sort of stuff.
Were you at Census and then went to the Fed, the New York Fed, or was it the other way around? New York Fed to Census?
The other way around. Yeah.
Yeah. Right. You have a very interesting, because in anticipation of this conversation, I went up and took a look at your recent research and work. You have a very broad portfolio. It's pretty amazing. I mean, talking about SEC and activists and minimum wage and just a really broad portfolio. It feels like a really cool job you've got there.
Well, lots happening.
Yeah.
The universe is not refusing to serve up material.
Yeah, exactly. Well, it's wonderful to have you and great to have you aboard. And AEI is a great institution, just a wonderful place, I think, for research. And you have this really cool event that you are kind enough to invite me to, and I've been going for a number of years, where you bring in folks from both sides of the political spectrum and some of the folks, some of the policy people and politicians, and it's just a wonderful 2-3 day event where people really have a chance to think about things and talk about.
Yeah,
things.
just last month.
Yeah, just last month. Really cool. Very, very cool. Okay, so what do you guys think we should do here? Should we play the game first or go talk about recession risks? What's your preference? Ryan, I'll leave it up to you.
No, every time I pick, it's the wrong one.
That's why I asked you.
Yeah, thanks, Mark.
Now, which one is it going to be, Ryan?
Let's do the game and then go
All
on
right.
a recession.
Okay, I'm gonna go with that. Let's go with the game. So just to remind everybody, the statistics game, this is a way to help people kind of get their minds around and digest the kind of the mundane economic statistics. But I'll have to say the statistics are popping. There's a lot of records being shattered in the economic statistics these days. It seems like every day a new record.
Which makes it interesting that we're talking about a recession.
Pardon me?
Like with all the data coming in, some of it's coming in really, really strong, but we're still going to talk about a recession.
Oh yeah. That juxtaposition is that kind of Alice in Wonderland for sure. But the game is we each state a statistic. The rest of the group tries to figure out what that statistic is through questioning and clues and deductive reasoning. The best statistic is one that isn't so easy that slam dunk, everyone gets it quickly. But you don't want something that's so difficult that no one's ever going to get it. And it's nice. You get bonus. You get a bonus if you can pick a statistic that that is relevant to the topic at hand, which in this case would be, or something that's come out recently over the last week or two. But we're talking about recession risks, so that would be a bonus. But it doesn't have to be; it can be anything. So with that, let's start with you, Ryan. What's your statistic of the week? And by the way, Michael, Ryan is a maven at this game. Although I have been giving him a run for his money in the last couple months, I'd say. Right, Ryan?
Yeah, you've been doing really well.
Yeah,
I've been really impressed.
Okay,
on a
I'll
streak.
take that.
Yeah.
Oh, and I should say, if you get this right, Michael, you get a cowbell ring. So.
Oh wow!
Yeah.
A cowbell.
We got two of them actually. Ryan's got
two.
Of them. Yeah, two. Of them.
Yeah, and if we're going to the office next week, I'll bring them in.
All right.
Yeah, we'll.
All right. So the number is 107.5 billion.
107.5 billion.
Mm-hmm.
And is this a statistic that came out this week?
It did. And it's negative.
Well, that
I
helps.
was afraid I was going to give it away.
Negative 107.5 billion. I'm going to take a shot in the dark just to get the conversation going. Is it related to trade? Trade statistics?
It is.
Ah,
Trade deficit.
and I don't think that's not the nominal trade deficit for the month.
No, that was 89.2
yeah.
billion.
Okay, I was going to say that actually, 89.2 billion.
You're getting there.
Okay. Could that be the current account deficit? No.
Mm-mm.
Quarterly current account deficit. No.
No.
Okay, we're back.
Stick with trade.
Stick with trade.
You're
okay.
there.
It can't be real, can it?
No, it's not real.
No, it can't be real.
It's nominal.
Nominal trade deficit is it some subset of overall trade?
Yeah, what makes up the trade deficit? There's two things.
Goods and services?
Right. So which one's
goods.
107?
Goods deficit.
Goods deficit. Very good.
Okay. All right. See how that's done, Michael? That's
not a cowbell.
How you do it, right?
That's not a cowbell though.
There's
a lot of hand-wringing.
Close though.
That was very impressive.
What's that?
That was very impressive.
Oh, okay. Yeah.
So the goods deficit.
I'm getting to know Ryan pretty well. I know I know.
Yeah, you're starting to be able to forecast what numbers I'm going to pick.
It's tactics.
Yeah, we should actually begin with that. That's a good one. So, okay, why'd you pick that though? What's the importance of that?
So we're importing a boatload of things. So it's 107.5 billion dollars is our goods deficit. So it's goods that we import minus exports, and that's overall trade. The 89.2 billion that we talked about is going to shave 1.5 percentage points off first quarter GDP growth. So that's going to be an enormous weight. So kind of getting back to the recession discussion, we have net exports that's going to subtract 1.5 percentage points, and then inventories, which are going to subtract 1.5 percentage points as well. So that's 3 percentage points of growth that we're getting cut out in the first quarter because of trade and inventories.
Let me ask you this. What's our tracking estimate now for Q1 GDP?
0.7% annualized.
So based on all of the economic statistics we've gotten to date, that would suggest GDP increased only 0.7 of a percentage point annualized in Q1.
Yeah, we were north of 1, like 1.1, 1.2, and then the trade deficit came out and brought us back down below 1%.
Yeah, and what's the probability that you think that we could get a negative number in Q1? Because if you said inventories and trade, we don't really have a good fix on that, do we?
Trade, we have a pretty good idea because we have data through February.
Yeah.
We're missing March, and we'll get some improvement in the overall trade deficit because the services surplus was affected by the Olympics because U.S. businesses or companies, they had to buy the rights to broadcast the Olympics, and that caused the services surplus to shrink. That's not sustainable. It's going to come back. So I think probability still, 25% that it falls. But yeah, that inventory drag, it really scares me. Could be more than what we're thinking.
Right. Hey, can I ask fundamentally, what's driving such a weak Q1? I mean, what's fundamentally behind that? In terms of GDP growth, I should say. It's not weak in terms of job growth, right? I mean, that's booming. So.
And I don't think it's fundamentals. It's again, it's net exports, it's inventories, and that inventory build is just because, we needed to replenish a lot of inventories, and we did that in the fourth quarter.
Mhm.
It kind of raised the bar. We're not going to be able to duplicate the amount of inventory build that we got in the final 3 months of last year, and that sets us up for a weak first quarter.
Did Omicron play a role? I mean,
Yeah, Omicron did. Yep. But if you strip out inventories, if you look at real finals demand, like that still posted a pretty solid gain. Should post a solid gain in the first quarter.
right. Okay.
All
Okay.
right, I got one.
Okay. Fire away, Michael.
11.8%.
11.8%.
This is
In
inspired by the template that Ryan just laid out for me.
Oh, so we're sticking with trade.
Nope.
No.
All right.
the template.
The general theme of a number relevant to my economic outlook.
Okay.
11.8.
Is it a statistic that came out recently, Michael?
It's a statistic that relates to the month of March.
Oh, okay.
Ooh.
And is it a measure of prices, inflation?
It is a measure of a price in a very important market.
In a very important market. Are you not being sarcastic when
Nope.
you say that?
No, no.
So are we talking about house prices?
Is it rent growth? Is it rent growth in the month of March? No.
Some food category.
Food
It's a
prices?
price. It's a price that has a name that begins with the letter W.
Wheat prices? That's up more than 18%.
I think Michael froze.
And important, the market I'm referring to is the labor market.
Oh, okay. 11.8%. Could that be wage growth like in leisure and hospitality or something like
Bingo.
Yeah.
There it is.
that? Oh, okay. Now wait.
That's a
wait,
cowbell.
Wait,
That's a
that
cowbell.
is
Yeah.
definitely a cowbell.
That's a good one.
I didn't hear the cowbell.
Oh my.
Yeah, there you go.
There you go.
By the way, do you guys notice? I don't see the dog behind Ryan. What happened to the dog?
I saw
Just
She
there
that.
actually
earlier.
moved.
Yeah.
She moved.
Yeah.
Oh,
Yeah.
she'll
she
be
is
back.
there. I can't see her.
Dog
For
Yeah,
is
some
she'll be back.
she'll be back. Okay.
She's going
Where's the
over
other
to
dog, Ryan? Where's Fenway?
Fenway is outside chasing
All right.
squirrels and everything. She loves it outside.
That's a good one, Michael. 11 point. No, that year over year, March over March, wages were up 11. This is average hourly earnings,
Average.
I assume.
Average hourly earnings. Yep.
Yeah, 11.8%. That is an amazing statistic, actually. Yeah.
Yeah. And so
They're
look
one of the
for,
few industries that's keeping up with inflation.
totally.
So you're seeing like real average hourly earnings increasing there.
Yeah. Which is related to a prediction, which is that people are going to start pulling back on dining out here quite soon, and that's gonna show up in consumer spending statistics.
Right. So you're saying that the surge in inflation is going to start to bite here, and consumers have no choice or they have a choice, I suppose. They could borrow, but they're going to pull back on their spending.
The law of demand will reassert itself.
Yeah.
Mhm.
Yeah. Actually, I saw a survey done by CNBC basically saying that they were asking consumers, are you pulling back on any of your spending? And they're doing two things. They're starting to pull back on their dining out, and of course they're driving. They're driving less.
Yeah.
As a result. Yeah.
I get increasingly irritated going to the same restaurants that my family's been going to for several years and spending 175% of what I'm used to.
Yeah. Well, okay.
Oh.
So I've got a couple of statistics. I like them both.
I've got
but
one related to the last one. If you want.
you
Oh,
have
then
one
let's go.
related to the last one.
Yeah,
So do I,
yeah.
actually. But can I
Okay.
ask on that one before you go, Chris? You'll go next. But
Okay.
I have a question for you, Michael. So Ryan has done some work trying to look at the relationship between wages and prices. This kind of concern about getting into a wage price spiral. And so far, correct me if I'm wrong, Ryan, you're coming to the conclusion that that prices are starting to drive wages. So, workers are saying, hey, you got to pay me more. But
Mhm.
there's not yet a lot of evidence that the wage growth is driving prices. He hasn't seen that. Do I have that right, Ryan?
That's
Yeah.
correct. So far, the causal relationship runs one way: prices driving wages.
Is that consistent with how you think things are playing out, Michael, or have you thought about that at all?
Yeah, that seems completely plausible. I mean, my kind of reading of the evidence of the past few decades is that the effect of wages on prices has been pretty muted, and I think that's largely because we haven't seen a whole lot of variation in prices. And so, when the variable that you're trying to explain doesn't vary, that makes it hard to explain it in a very kind of mechanical, statistical sense. I, expect that as we kind of continue to march through this inflationary period, some of these older relationships will start to reassert themselves. And I would expect prices to drive wages. I would also expect wages to drive prices. And kind of disentangling a statistical relationship where the causal arrow points in both directions is pretty tricky. Doesn't surprise me that would begin with a situation where prices drive wages, but I don't think that's where it will end.
Yeah. Yeah. And I guess we can come back to that in the context of recession risks too, because
Mhm.
it plays a role in that. Okay. Okay, Chris, you're up. So what's your statistic?
All right, I'll give you two. It's 12.6% and 34%.
12.6% and
Did
you
this
said
come out
30
this week?
Yep, it came out today.
Came out today.
Oh, I think I know what it is.
Oh,
Is
if
it
you get this, that's a double cowbell. I would have to say.
okay, okay, is this
Nothing
around
came
food
out today.
prices?
It is.
Is it the UN's FAO
Oh
price
my,
index?
you got it.
No
You
way.
got it.
All right, this is there was something going
Okay.
on.
All right. All right. Okay. I get 2 cowbells for that.
What are the
baby.
two numbers? Do you know?
I think the 12.6% is the month over month increase. That's March.
Yep,
In the
the
34%
34.
is year over year, I would
You
think.
got it.
Right.
That's
So
right.
food
12.6
prices.
in 1 month.
Okay, that's okay. Okay. You got to be impressed. You have to be
I'm
somewhat.
impressed.
So I'm sure someone out there is thinking that was a plant. Was that
Yeah,
a plant, Chris?
that was definitely
That was not a
planted.
plan. No,
All right. All right. Very
we're just
good.
in sync.
That was more impressive than the 11.8.
I think
Yeah,
these two
yeah.
are sending emails at night saying, "Oh, watch out for this number. Here it comes."
No,
Can't let
no.
Ryan get any numbers right.
Yeah, that's very good. Okay, so you got to explain this. What is this, and why is it important? What's going on here?
Yeah, so this is a food price index. It combines food prices from a number of different categories like cereals, so wheat, corn, other grains, vegetable oils, dairy, meats, various food categories. It is from the Food and Agricultural Organization of the UN, so it's an international measure, right? So it's trying to capture food prices in different regions of the world as well. So 12.6% in 1 month is the largest gain I've seen in the history of the data. Certainly, and it's a big movement here, and 34% in movement in food prices just over the course of the year. That's certainly going to continue to contribute to inflation. Food is not something you can easily correct, and it takes time. There's a cycle here for growing, so I suspect this is going to continue to weigh on us. And certainly this is stemming from the Russia-Ukraine conflict, right? So without those exports, not only are we going to face higher food prices in the US, but these higher food prices are really going to take a toll on emerging markets and other economies around the globe. So I worry about those repercussions coming back on the US as well.
Yeah, I think this is a big deal. I mean,
Yeah.
because not for the U.S., but particularly for the rest of the world. I mean,
Yeah.
I had to give this talk. Not have to. I gave a talk to this group of folks in Nigeria. Actually, I met Bill Gates for the first time
Oh,
on Zoom because
wow.
he sponsors this group. A very interesting conversation, and in preparation for that, I learned that in Nigeria, if you look at the consumer basket of Nigerians, over half is food. Here in the United States, I think it's 10, 15%, right, of the CPI is food, something like that, 13,
Yeah.
14%. But 50%, over 50% of the Nigerian consumer basket is food, pretty significant. So I think this is a big deal. Also, the other interesting thing, this came up in our macro meeting yesterday. Brendan Lacerda, one of the other economists that follows the ag industry closely,
Oh, yeah.
pointed out the collapse did you see this? The collapse in farm inventories in the United States.
Mhm.
I mean, just
Yeah.
we got data all the way back to World War II. You look at the chart of this thing. In fact, I'm going to tweet this thing because it's just an amazing graph. You see this very sharp decline in the stock of farm inventories and record lows by orders of magnitude, which is kind of spooky, a little nerve wracking. And I asked him about the detail, what's driving that, and he's still working on it. But it looks like a big declines in wheat stocks and corn and barley, things that obviously the Russia and Ukraine export. So very important. Okay, that was a good
Yeah.
statistic. Okay, I've got a good one. It's a little. I'm going to state it in a little different way. I hope this isn't too hard. This statistic is as low as it's ever been since Thanksgiving week 1968. 1960.
Jobless claims.
Very good. Jobless
Yep.
claims.
Yep.
That's
That
two
that
thousand.
number was outrageous.
Brad, you
Yeah.
beat me by 1 second.
Yeah.
Oh,
Is that
great.
right?
That's
Oh, okay. That was easy. I thought that was going to be hard. Jeez.
No.
That one stuck out this week.
That one
Yeah.
stuck out.
Okay.
Yeah.
So go ahead, Ryan. You want to, or Michael? Do you want to talk about that? What happened this week with UI claims?
Well, they were the lowest they've been since Thanksgiving week of 1968.
So there you go. Very good. And I think, correct me if I'm wrong, but I think on a 4-week moving average basis, which is kind of sort of how economists tend to look at it, because you can have these weird weeks, every once in a while.
Yeah.
I think it's the lowest it's ever been in the data. 170,000 initial claims for unemployment insurance in the last 4 weeks. And that's the lowest. I couldn't, there may be a week, I couldn't see it though. I think it might be the lowest on record. That is
Mhm.
just outrageous, incredible. It shows you
Yeah,
how,
it's unbelievable.
yeah.
I mean, it just shows that businesses are very reluctant to lay off workers because they know how hard it's going to be to replace them. So,
Yeah. Well, I guess this is a great segue into the topic at hand, and that's, recession risk. And the way I want to kind of introduce this conversation is begin by asking each of you, I guess broadly, how are you feeling about things, in terms of the economy and where we are in the business cycle? But more specifically, what odds would you put on us going into recession at some point over the next 12 to 18 months? So, just to give people context as to how you're feeling. So Michael, let me begin with you. How would you characterize things, and what odds would you put on a recession over the next 12 to 18 months?
I would put 2/3 probability of
Wow.
recession over the next 18 months. Or maybe we broaden it, not so much 18 months as 20 months, at some point in
End of 2023.
end of 2023.
Okay.
I see two big risks to the outlook. One is what we discussed a little bit earlier, which is the law of demand kind of reasserting itself. I expect to see consumer spending weaken under the face of these prices. I expect to see business investment spending weaken under the face of huge increases in producer prices. And that, when you have businesses pulling back and consumers pulling back, that's a pretty large chunk of your economy right there. I think a second risk is a policy mistake by the Fed in the face of this. I think the Fed just fell extremely behind the curve over the course of 2021. I'm becoming increasingly worried that they are going to make a symmetric mistake in 2022. That they underreacted in 2021, they might overreact in 2022. If the economy is going to slow down on its own, right? You're seeing, Chris is at this housing conference. You're seeing 30-year fixed rate mortgages jump up considerably based on forward guidance and quantitative tightening. That should slow the housing market down. You're seeing the 10-year jump up pretty considerably. as a consequence, again, of a combination of short rate and QT tightening, that should slow down investment spending. And households again are I think they're going to be less likely to go out to eat, and they're going to be less likely to buy a new dishwasher. And that's going to naturally slow things down on its own, to say nothing of what's happening over in Europe and in China, which are going to depress U.S. exports. So in light of that, I think the Fed still needs to tighten. I mean, I think there's not much question about that. But if we're really talking about trying to tighten 250 basis points in 2022, really aggressive quantitative tightening, could we have 2 quarters of negative growth? Yeah, I think we might.
Wow, 2/3 probability. That is high. So you feel pretty confident we're going in. Let me just tease out a couple things you said. First, your point that because of the high inflation, that obviously undermines real after inflation income, and people will respond by pulling back on their spending, which is, the fodder for recession. But what about all of the so-called excess savings that consumers have? So, if you add it, if you take a look at all the savings that was done during the pandemic, above which would have happened without it. So go to the savings right before the pandemic, just assume that would be the same, and do the calculation. There's 2.5, 2.6 trillion in excess saving, above which people normally. So that's sitting in people's deposit accounts. That's been driving a lot of home purchases, maybe investments in the stock market. How do you think about that in the context of they'll pull back because they have all that cash?
Yeah, it's a great question. I think it's one of the best examples, I think, of the extent to which over the past 2 years we've kind of been in uncharted territory. How do we think about how households will spend down $2.5 trillion of excess savings that were built up by supply restrictions and by restrictions on business activity? I don't know. I think the kind of closest historical analogy I've seen is from World War II, where factories were repurposed to produce war materials and munitions, and so there were gaps in consumer markets where consumers would have spent money on things that they weren't able to buy. Households accumulated a lot of excess savings during the World War II years, and my understanding is that it took several years for those savings to be run down. And so, one answer, Mark, to your question is, based on that period, which obviously is not a great fit for the period we're currently in, but based on that period, we might expect a gradual rundown of these savings. We aren't seeing really depressed savings rates. And so there's not much evidence over the past, 6 months or so of dis savings. So consumers aren't, pulling into their savings as a way to cope with reductions in the purchasing power of labor income. I think kind of a more detailed forensic analysis of these savings would be helpful. If I had to speculate, I would say that there are kind of two things happening here. Middle class households, upper income households, put those savings in the bank, so to speak. They use them to purchase homes. They use them to fill up 529 accounts. They use them to invest in equities, and they're not gonna take money out of the 529. They're not gonna take out a home equity loan. They're not gonna sell stock in order to pay for their Saturday afternoon lunch bill. Lower income households, I think these excess savings likely contributed to the stagnation of the workforce participation rate that really only began to climb 6 months ago or so. And those savings may have been used to kind of finance
Mhm.
normal expenses, to pay rent and to pay for groceries and things of that nature. So, uh, I would have thought that we would have kind of had more of a Mardi Gras type atmosphere when the pandemic ended, and you would see households burning through this cash, and maybe it's because we didn't have like an abrupt end to the pandemic. It's kind of
Yeah.
ebbed and flowed more. But I don't expect, I mean, I expect that to be a boost to consumer demand, but I don't think it'll be such a big boost that uh, act as a complete counterweight to the effects of inflation on consumer spending.
Got it. Got it. Yeah, we've done a little bit of work trying to decompose that excess saving across different demographics, including income, and it's based on data from the Survey of Consumer Finance and Financial Accounts from the Fed. So we have the last data points for the fourth quarter, and it's still pretty considerable across all income groups. I wonder what kind of cushion. And I think you're right about high income households. They view it as wealth. They don't view it as income, and probably, but they're not the folks that are going to be really hurt by the high inflation. But the low income households, they've got a little bit. If you believe the data, and again, it's pretty. They're estimates on top of estimates. Feels like they got a little bit of cushion there. But that's a good point. Let me ask you one other question about uh, what you said about recession risks, and about the Fed and the Fed making a mistake. So the markets seem to be anticipating some pretty significant tightening here. Half point tightening in the funds rate at the May meeting of the Fed, probably another half a point in the June meeting, getting the funds rate back to the so-called equilibrium rate, R star, of about 2.5% by no later than this time next year, and then even a higher rate than that, a terminal rate that's somewhere closer to 3. The markets also seem to be now completely discounting quantitative tightening. That is allowing the balance sheet of the Fed to run down, and maybe even selling. The Fed's starting to sell securities. That's why one reason why mortgage rates have jumped is that the markets are concerned that they're going to sell mortgage securities that they purchased. Okay, so that's what the market thinks. So if that's and it looks like the Fed and Fed governors are okay with the market thinking that, they're not pushing back on that. So let's say that's the forecast for monetary policy. Do you think that's a mistake, or do based obviously there's a lot of script to be written here, but based on what do you think that's roughly right with getting the economy to navigate through without a recession, or that's just not going to work? They're
I
not going to be able to do it.
I think they're just in such a bad position.
Yeah.
I mean, let's say the funds rate is at 2%, or 2.25 at the end of the year. It's still going to be considerably negative. And the markets are expecting this for sure. But what actually happens in the real economy when you have that degree of tightening over a short period of time, but where you're still looking at an interest rate that is -3% or something like that, depending on which inflation measure you use. I don't know the answer to that. I think we're kind of in the territory we haven't been in for a half century. But I worry about the jolt. I also worry about the balance of what the Fed is doing. The Fed was still purchasing mortgage-backed securities last month,
Right.
which is I think bizarre. The Fed seems to be averse to relying more on quantitative tightening and relying less on policy rate increases. I would flip that. I mean, I think they should be more aggressive on QT and less aggressive on the funds rate, because QT will raise rates at the long end of the curve. QT will slow the housing market, which is where a lot of our problems are, and that will still not invert the yield curve, and not it'll reduce the risk of the kind of, you know, scary stuff happening that actually jolts
Mhm.
people, even when markets are still expecting, you know, pretty aggressive action. So I kind of feel like the Fed is in a damned if you do, damned if you don't type situation, and it will be hard to kind of, you know, get the lag structure of monetary policy right in an economic environment where I think it's pretty clear that consumer spending is going to slow, but it's not clear how aggressive it's going to slow. So, you know, my concern is that it's looking like if you look at some of the anecdotes and some of the data that have come in really recently, it's looking like consumer spending is going to slow faster than I would have thought 2 months ago, and I worry about the Fed not being able to keep up with the pace of change in the economy, similarly to how they didn't in 2021, but the converse.
Okay, let me turn to Ryan. Oh, maybe I should turn to you, Chris, because I know you have to leave in about 15, 20 minutes to catch a plane. So you heard what Michael said. So what's your assessment of the probability of recession over the, let's say through the end of 2023, because that Michael says 2/3 through the end of 2023. And also, you know, if you have any comments or thoughts around what Michael said, that would be also, I'd be very curious in that as well.
Yeah. So we have models, right, that try to predict probability of recession.
We
Right,
got many models.
we have many models,
many models.
right? So based on economic variables, based on financial variables like the yield curve. Right now, based on my read, and you're right, there are lots of variations, but looks like they're all converging around 35%, 35% is what I'm seeing. That
And is
sounds
that
like
what you're saying?
that.
So
Well, I'd say that's my starting point.
I know you're a
but
slave to your models. So are
no,
you saying?
well,
Yeah,
that's where
okay.
I'm going. I'm not a slave. It's a
Oh, you're not a slave
that,
to your model. Okay, go
that's
ahead.
a
All right,
that's the
that's the
starting
model
point.
say. All right.
My model says that about a third chance,
Yeah.
but then I would certainly overlay the high probability of a Fed error during this time. So very much in agreement with Michael. It's a very these are uncharted waters. Very likely that at some point we'll make an error given the lags in the process here, right? You hike the rate, you don't see the effect for a few quarters ultimately, so you're kind of driving in the fog or in the dark here. So I would bump up that 35 to maybe 45% based on that, and then on top of that, I think we are extremely vulnerable to any other type of shock from here on out, right? So some additional geopolitical risk, another wave of COVID, right? There could be another strain out there, the food insecurity. I just see that there are so many possible risks here, and it doesn't take much at this point to tip us into recession because we don't have a lot of firepower left at this point. So for that reason, I actually bump the probably to 55%. So
Whoa. Oh. That actually
Just go bump it up a little bit more.
and we're
Yeah.
almost there, right?
Hold it. Okay, so does that mean you disagree with our baseline forecast of no recession?
That's what above 50% means.
I'm getting there. Yeah.
Oh my gosh. What did
But then,
okay.
that would be consistent with your views on house prices.
So this is a change though, right? Because Chris, if I asked you this last month, you wouldn't have said 55%.
No, but things have changed in the last month, right?
And what changed?
I'm really concerned about the inflation expectations.
Okay.
Right?
Russia invades Ukraine, oil prices go skyward, takes inflation expectations with them. That's what's changed.
Yeah, they are not.
Okay.
There's no sign of bending the curve there. And
my goodness.
that has to be the top priority for the Fed. And I think there's a good chance that, like I said, they'll overdo it.
So Michael's at 2/3. You're at 55%.
Yeah.
Oh, goodness gracious. Okay.
But Ryan's the
all right. Well,
optimist,
can
so,
I? What? Going back to this before I go to Ryan quickly, because I don't want to. I know I'm going to lose you in a few minutes.
Yeah.
Going back to Michael's point about the consumer pulling back, and I push back a little bit, saying, "Hey, excess savings." The other thing that you and I noticed, and Ryan noticed yesterday, looking at the consumer credit data, there's been a big increase in borrowing recently, or at least in the amount of debt outstanding, which may also be just an increase in transactions, people using their credit cards more because they're traveling more, that kind of thing. How does that fit into all of this? Do you think is that worrisome to you that we're seeing this significant increase in credit growth, or do you view this as a cushion to us not going into recession? How do you think about that?
Well, I think people that are consistent with Michael's view, there are people borrowing for different reasons, right?
Mm-hmm.
So the nice thing about our data, or the interesting thing about our data, is that we can actually break out these this credit growth by credit score. People with higher scores, who tend to be higher income, are borrowing at a fast clip, but I view that as more the traveling or the getting back to spending. I'm worried that about the very fast fast pace of growth of the folks with lower credit scores, right? And I think there we're seeing a lot more borrowing for necessities to deal with inflation. So yeah, there's some cushion that's being put on here in the short term, but with rising rates, right, payments going up, these are variable interest to bearing accounts. So there's going to be much more stress on those lower income consumers. And I think they're tapped out. Once you get your update of the data, I think that the savings of those lowest income households are now below what they were at the start of the pandemic.
You think they spent that money in the last 4 months?
Well, it's been a steady decline since the middle of last year, since the end of the unemployment insurance benefits and stimulus checks.
Steady decline in
the savings.
What? The saving rate.
Yeah,
okay.
exactly. Well, yeah.
Right.
So they're
It's
drawing
still,
down those savings. I think they're back to where they were.
Okay. Boy, that's a shock. Hey, Michael, that's a real shocker, because usually Chris is this, kind of down the fairway, don't stir things up kind of economist. But that's a statement. Okay.
Yeah, I thought he was going with the traditional 40%. Did you read about that? It's like 40% is like the ideal probability for economists to say.
For forecasting. Yeah.
Right, for forecasting, because not always going to be like, you're not wrong if you say 40%. So
isn't that also the unconditional answer? I mean, in any given year, there's 20% chance. So in any year period,
yeah, there you go. See, that's where Chris was going.
Okay, well then you guys are just laughing at me. I'm a little nervous to tell you about my probabilities now. You guys are bullies. You're intellectual bullies. I can feel it. Yeah, all right. Well, we'll come back to me, but Ryan. Now I'm really nervous. Ryan, what's the probability of recession between now and the end of 2023?
75%.
Whoa!
Ooh.
Wow!
It's done. I think the seeds for recession.
In the fairway.
Yeah, exactly.
Okay, all right. When you say it's done, like what's your thought process? Is it different than Michael's, or what's
No, I agree with everything Michael said. I mean, if you look at just the shift in Fed rhetoric in the last few weeks, I mean, they're hell bent on bringing inflation down, and they're in a bad situation. And it's very hard for me to see them pulling this off without some sort of misstep. So they're going to go too aggressive on rates. I agree that they should use the balance sheet more aggressively and then kind of ease into rate hikes. But I don't think they're going to do that. I mean, if you look at Powell's usually like right down the middle of the fairway, kind of like Chris. His comments recently have been, if he doesn't see inflation moderate on a month-to-month basis, which we're not going to for the next several months because of higher gasoline prices,
right?
That's his signal to really tighten with regards to rate hikes. I think that they're going to make a policy mistake, and the labor market's it's rip roaring, and there's nowhere to go for the unemployment rate but up. So once the unemployment rate starts rising, a recession always follows.
Well, you're saying the Fed's going to press on the brakes too hard. I mean, we know the way I framed it for Michael was, here's what the market thinks. Do you think that that's the catalyst for recession? So let me ask you it the same way. You know what the market is saying, the equilibrium funds rate, 2.5% by this time next year. If they follow that script, you're saying that's recession? That's a mistake?
Recession.
So
that's
should they not,
the market's already
they shouldn't press on the brakes. They should just, why wouldn't they just press on the brakes less hard?
But they could do that if they were going to adapt. And that's the wild card. The Fed could adapt, but it doesn't seem like they're going to. Like they're
not going to. Yeah, they're prices are going to continue to go up.
Mhm.
And they, I think, are not, I just think they're not nimble enough to say, okay, our policies kick in with a lag. Here's why prices are going up. We need to adjust on the fly. I think they're going to say, we raised 50 basis points in May, and then the May CPI came in at 10%, and that means we need to raise even more. And I think that's the kind of dynamic that could take hold.
Yeah, in the
Right.
past, they've usually signaled that they're going to take a breather, like a pause, kind of reassess how tight, or how appropriate monetary policy is. No signal that they're going to do that this time. I mean, they're going, once they start, it's going to be a steady pace of aggressive rate hikes.
Okay. Look, so we sit down and we do a forecast that we put
Mhm.
pen to paper. We provide to clients. Are you saying to me, the two of you, Michael, if you're, I'll put you aside to a second but this is really critical to our client base. Are you saying to me we should have a recession in our baseline? Is that what you're saying to me exactly? Or are you just playing podcast one-upmanship here?
No, there's no podcast one-upmanship. This is if I had to create a forecast, I don't know.
You have to create it. What are you talking about? You have to create a forecast. We create this
there-
forecast. You're saying if I were
there's
chief
the Zandy
economist, is what
factor.
you're saying. You're saying
Yeah,
I'm
there's the Zandy ad factor.
Mark, if you weren't around, I'd have a recession. Is that what you're telling me?
I'd be very close to having a recession. Yep.
No, not close. You would
I would have a recession.
because 75% is not close. That's like you said
Mhm.
we're done.
Yeah, I think yes. By the end of 2023, we
All right.
experience a recession.
Chris, I'm out of here. I'm out of here. I'm Monday. You're the chief economist. You're telling me you would put a recession in the baseline forecast. Is that what you're telling me?
So if we use your 2/3 rule,
Oh, okay.
I
There we
wouldn't,
go.
but
He's
I'm
so
getting
smart.
off-
He is so
I'm
smart.
I'm getting awfully close.
Mhm.
Okay,
Thing is, I don't
explain
know
the
that-
2/3 rule. Explain the 2/3 rule.
So the is this did it originate with you, Mark? Or I don't know what the
Yeah,
history
this is
of-
my rule.
This is your
This
rule.
is my rule.
Okay.
Yeah.
Yeah. So the 2/3 rule states that if you have to have conviction of at least 2/3 of an event happening before we alter the forecast.
So if Michael was chief economist, he said 2/3 recession in the baseline. We would change recession in the baseline.
I would put recession in your
Ryan.
baseline, but just to be completely fair to Ryan and I, if there's a 33% or 25% chance of rain, you probably still bring an umbrella.
Right. That's a great point.
Right. Good point. Good point. Okay. Does anyone care what I think? No. You guys.
Yeah,
don't?
cheer us up. Cheer us up here.
Okay. Okay. Sure, Mark. You tell us what you think. Well, obviously, I'm very nervous about recession risk, but I'd put the probability at 40%.
40%.
Oh, there we go. There it is.
Through the end of 2023. If you said through the end of 2024, then I'd say, okay,
60. That's 60.
yeah, it could be at least even odds if I went through 20. Because the other thing that could happen is, and this is why my questioning around the Fed could say, oh, I don't want to push the economy into recession, so I'm going to ease up. But then you get into kind of a more stagflation kind of environment. And then ultimately they have to push us in. And that's a later event. That's not a 2023 event. That's a 2024 or 2025 event. So
Well,
I would
markets
say
have rate cuts priced into 2023. So
Yeah.
the markets are basically saying the Fed's going to make a mistake and they're going to have to ease next year.
But let me just fundamentally tell you why I don't think we go. The odds are that we don't go into recession, and it goes to the fundamental strength of the consumer and the American businesses. I mean, the consumer isn't in I'm painting with a broad brush here, obviously, and there's difference between high and low income, but the American consumer is in fabulous shape, right? I mean, lots of jobs, low unemployment. Wage growth has fallen behind inflation now, but generally we're getting positive real wage gains, and I expect that to occur if, in fact, we don't get another supply shock here, if Russia doesn't go off the rails, or China doesn't shut down because of the pandemic. Leverage is low. Debt service is record lows. People have locked in these low rates. They've refied down into 3.5% mortgages that aren't going up. Asset prices are high. The stock prices they've come down a little bit, but they're, 5% down, up 30% last year. House prices still going, lots of equity. You got and this is my term, boatload of excess savings pretty much across the board. So, okay, I hear you. I think we'll see some pullback in spending by low income households that are getting nailed by the higher gasoline and food prices and rents. I get that. So I expect slowing, but we need slowing. I expect that. American business. I don't know. I've never seen a time when American businesses are in as good a shape as they are right now. I mean, the corporate profit margins are as wide as they've ever been. They're making a lot of money. The cash is rolling in. Leverage, they've locked in. Leverage, and again, here I'm painting with a brush, and I think corporate leverage is a little bit more of an issue than household leverage, because you do have some businesses that have levered up, but mostly because of financial engineering. But corporate leverage is low, in aggregate. So, and they've locked in. So, and investment is very strong. And even with the rise in rates, we're talking about rates just normalizing. We're not talking about rates. We're talking about rates going to 2.5% on the funds rate, or a 10-year yield of 3.5%, 4%. Mortgage rates of 5.5 to 6. So I don't know. It just feels like there's fundamentally we're in good shape here, that we can weather this is no doubt a storm, a very significant storm, but we can weather the storm. Okay. I'll stop my rant. Did I change your probabilities at all, guys?
No.
No.
It might have gone up.
It might have gone up. Oh, that's so funny. Okay.
I will
So
say
you're ignoring
that
the yield curve.
Okay,
Go ahead,
wait a
Chris.
second. We're going to come back to that. There's one other part of this discussion we got to have, and that is, what are we looking at to gauge which path we're going down? But Chris, you had something to say before we do that.
Well, I think I will say, for your point, that I think the severity of the next recession will be mild, right? So
He's
I'll agree with
good.
that,
You guys,
right?
he's really good.
Well,
He's really
because
good.
all the fundamentals are still quite strong. So we'll get into recession, but it's not going to be a total collapse, or
I think it'll be one
I
of
don't
those
foresee
recessions where we don't know if we're in it until we're out of it.
yeah,
Yeah.
it could be something like
Oh,
that. Yeah.
that's interesting. Okay,
Especially if it's driven
now
by
I changed your
inventories.
mind. I think I changed your mind a little bit here. I can feel the shading going on here. Oh, it's going to be a modest recession. Yeah. Okay.
Well,
I-
remember the definition of a recession.
Broad-based,
Period of economic
sustained
weakness.
decline in economic activity.
Right.
Not 2 quarters of negative GDP.
No,
You
so
could have
the
that.
threshold's pretty low.
I don't know. Okay. That's interesting. You think that's a low threshold. Okay.
And it's not gonna be a financial crisis or
Yeah.
pandemic type recession where there's a deep flaw in the underlying structure of the economy that has to be unwound. It's just gonna be people are gonna spend less money because everything's really expensive.
Yeah. Wow. Okay. All right. Okay. Each of us have now got to articulate a indicator, or let's say one, maybe two, that they're looking at to gauge which path we're going down. The recession path, the one we've just been discussing, or something more benign. We're definitely going to see slower growth, but that's by design. But we avoid a full-blown recession. So what are you looking at? Michael, what are you looking at?
Real consumer spending.
Oh, okay. So there's no like one indicator you look at to say, hey, this is signaling we got the probability of recession being high. I mean, once real consumer spending goes, we're done. We're in recession, right?
That's where I'm looking, because
Okay.
I think that's where this recession is going to come from.
Got it. Okay. All right. Chris?
So if we're talking recession signal, it's got to be the yield curve. So
Oh,
Gotta be
God.
the yield curve.
gotta be.
It
gotta
does
spot
not
that.
need to be the yield curve.
I'm
Okay.
not. I mean, I thought that. What's the yield curve? Yield curve inverts tells you that we're going to have a recession at some point in the next 2 years.
Right.
Well, yeah.
All right.
Yeah.
Well, that's kind of what we're talking
Well,
about, right?
isn't that?
Well, yeah, but
Yeah.
I'm saying.
Yeah.
You know,
You're saying it's not very precise about when this recession is going to occur.
it's not very precise.
Yeah.
It's a pretty small sample.
Mhm.
And there are yield curve versions, and then there are yield curve versions.
Yeah, for sure.
Yeah,
for sure.
sure.
So,
Not talking about a
Chris, what
temporary.
you say yield curve? There's lots of yield curves. What yield curve are you looking at when you say that?
It's 10-2.
10-year
versus 2-year.
treasury yield minus 2-year treasury yield. And if
Yeah.
if that's generally positive, 10-year yields are higher than 2. But when the curve inverts, 2-year rises above 10-year, that difference goes negative. That would be a signal that we're going down the recession path.
Right.
And
At least
when
it
you
has
say
been in the past. So
hard, like
a
what
hard
kind of
recession.
inversion? Like it inverted, by the way, a
Yeah.
10-year inverted for a day, I think, right, Ryan? 2
Like a
days.
basis point, right?
Yeah, it was.
Well, I'm
it was a
asking.
small
I'm
brief.
asking. What do you?
Yeah.
So what's
No,
your signal?
it's got to be more than that. There are certainly technical issues that can cause the curve to invert, right? That wouldn't signal some recession. So I'm saying, 10 basis points or more for several weeks, right? That's kind of the minimum threshold
Okay.
to say.
It could be
Ryan, you
misleading.
don't like
High probability.
I hate the yield curve.
why?
It's going to be misleading
About
because the
misleading
10
about
year is no
what?
longer a true risk-free rate. So if the Fed decides to use quantitative tightening more than rate hikes, the 10-year treasury yield is going to rise, and it's going to distort the message coming from the yield curve. So you could
See-
actually have a recession without a yield curve inversion this time around.
Yeah, I maybe but isn't the quantitative easing and tightening, the bond buying, the bond selling, pretty much across the treasury curve? It's not just 10-year yields that they're buying and selling. They're
No,
bonds
you're
that
right.
they're- It's
Yeah,
across
it's-
the curve. The
It's
bias
across
is
the
Yeah.
curve, but
The MBS is
yeah, the
long-term,
MBS is
right?
different.
yeah, okay, but there's always bias. Okay, fair enough. But I do believe the yield curve is a very, very prescient indicator. But it has to be a hard inversion, not
Yeah.
Mhm.
not a day or two, not a week or two. It's got to be a month or two.
Yeah, so we
And,
haven't.
Michael, you're right.
We haven't seen it yet.
we have
it
not
hasn't
seen it.
No.
yet.
No.
Yeah.
So that would be consistent with my forecast, not your forecast. just saying. Just saying. All right, Ryan. And I'm a yield curve believer, maybe even a proselytizer.
Mhm.
Chris is a believer. Ryan
Fossil.
I'm a skeptic.
is a skeptic. Okay, and
Mhm.
and Michael is a deny. It sounds like a denier. Yield curve.
I'm a
denier.
stronger believer in Chris's definition of inversion than I
Okay.
than I am in what we've seen so far.
Got it.
Okay, that's fair.
All right, fair enough.
Mhm.
All right, Ryan, give me an indicator.
Jobless claims. So
Okay,
it's weekly.
so,
and
all
it's
right,
just a
so-
count of people that are
Yeah.
filing for unemployment insurance benefits.
Yeah. So,
So-
what's the threshold? What do you need to see?
No, if we get back up to over 250, close to 300, then that would be a warning.
Oh, well, geez.
We have a long ways to go.
But
This
Yeah.
this thing can turn quick.
All right.
So that's the opposite end of the yield curve discussion, right? That if we see that, we are in,
We're done.
right?
Yep.
We're there, right?
Yeah,
It's-
because jobless claims are useful in kind of predicting what the unemployment rate is going to do. And
Yeah.
the unemployment rate, if it rises by 30 basis points on a 3-month moving average basis, a recession is always followed.
Right. So there's no advance warning with it. It's just proof positive.
Right. It's kind of like Michael's point. We're going to probably know we're out of the we're in recession when we're coming out of it.
All right. Okay. I'm going to give you 4 indicators, and this is leading indicators, not the it's already we're in indicators. Number 1 is the yield curve. That gives you 12, 24-month advance notice, and that's got to be a hard inversion, 10-year, 2-year. Second, the equity market has to go down a lot. It's got to go down 20%. It's down 5. There's that old adage: the stock market's predicted 10 of the last 5 recessions. That's true, but it never. We've never had a recession without the equity market, the stock market going down significantly, and that gives you like a 9-month lead to the recession. Third, consumer confidence that has across all measures has to definitively cave, because at the end of the day, a recession is a loss of faith. It's back to Michael's point about the consumer, but the confidence measures have to go down in a big definitive way, 20, 30 points in, a couple, 3 months. And that means they're running from the bunker. And then finally, the unemployment rate rising more than a quarter point over a 3-month period. I agree with that. That is indication that you are in recession, because at that point you're in a self-reinforcing negative cycle where unemployment's driving people to run for the bunker, stop spending, and you lose jobs and so forth and so on, and you're in recession. So
Don't we
those
check
4.
off?
And so far, fellas, I'm just saying none of those indicators are saying recession. I'm just saying.
Oh, I don't know. Consumer sentiment is
Yes.
lower
Michigan,
today.
University of Michigan.
University of
That,
Michigan consumer sentiment is lower today than it was during the lockdowns.
Yep.
that's true. That's the
It's
University.
cons-
I'm saying across the board, all the sentiment is because that's got its own idiosyncratic things. But I agree. I hear you. I hear you on that one. But
The
that would
lockdowns were
say,
pretty bad.
pardon me,
The lockdowns were pretty bad.
they were pretty bad. Yeah.
But the consumers think that now is worse than that.
Are you saying we're going to have a recession like in the next 3 months? No, we're not going to do. That's not what you're saying.
No.
Yeah. Yeah. Okay. All right. Okay. I got one more question.
It could hit it the third quarter.
I want this podcast. We need a gold star on this podcast because we're going to come back to this podcast and I'm going to tell you, I told you so. I'm just saying, Ben, somewhere in Spotify, put a big red arrow on this podcast. I better
It's
be
the
right.
anniversary podcast, right?
The anniversary podcast. Okay, I have one last question. This is for Michael. Okay, you talked about what the Fed can or can't do. What about lawmakers? Is there anything they can be doing, should be doing? They obviously nothing. Okay, there's nothing.
I think nothing. I mean, the big thing I would say to lawmakers is do no harm. That's the most important thing they can do. And it looks like they aren't going to. I mean, now I think would be a terrible time to jack up the deficit, particularly the 2022 or 2023 deficit. But other than that, fiscal policy is pretty limited in what it can do right now.
Yeah, and you're not. So when you say do no harm, you mean like a cut in the gasoline tax? You would consider that to be, because that's being discussed, I guess.
I think
by
that would
some.
be pretty. The impact of that would be pretty trivial. I think.
Yeah.
It'd be great for the gasoline suppliers.
Yeah, they just capture some of that cut. Yeah.
Yeah.
What they really could do is they could build a time machine and go back to March of 2021 and not pass the American Rescue Plan.
Oh no,
Oh,
no,
I don't
no. Okay, damn.
I don't think we.
That's a whole nother
Oh,
podcast.
that's a whole nother podcast. Damn. Oh, he waited to the
almost
last
made it.
minute. You said bomb, boom. Okay, we're definitely if you're up for it, Michael, and it won't be the "I told you so" podcast, but hopefully we'll have you back. And
for
we can
sure.
talk about the American Rescue Plan. But this
Absolutely.
was before we end, Ryan, because we have started a new feature on our podcast where we answer a listener's question. Do you have one you want to post to the group from one of our listeners, Ryan?
Yeah, so a listener reached out and asked how our view of the refugee crisis in Europe is affecting our forecast.
Oh, okay. All right. Do you want to take a crack at that, Chris? What do you want me to go take a crack at that? How do you want to respond to that, Ryan? Or Michael, do you have any views on the impact of the refugee crisis on the economy?
I think the war is having a big impact on
for sure.
on commodities prices and on the kind of overall economic outlook for Europe, which has implications for the U.S. economic outlook. I'm not sure that the refugee crisis in isolation is having a big impact on the U.S. economy, but the war certainly is.
Yeah. Any comments on
Yeah.
that, Chris?
So,
Yeah.
yeah, I would agree. Not the U.S. Certainly, if we're looking at specific countries in Europe, right? Obviously, there's a bigger impact there. So if you're looking at our global forecasts, and we are factoring some effects, I believe, in Poland and Germany, whatnot. So
I think in the near term, obviously, it's a very significant economic burden on the rest of, particularly Europe.
right.
But I think long run, it's probably a big plus, right? Because Europe has some very significant labor market demographic issues, and the folks leaving Ukraine are in many cases highly educated, skilled, good, very positive for labor force and ultimately innovation and change and business formation. So I think that it will just add to the dynamism of the European economy. Hopefully, the near-term costs aren't too high and they can be absorbed. And I think my view, it makes sense for the United States to make it a bit easier for Ukrainian refugees to come here. We've only allowed, I believe, 100,000 in, and I don't know that that's anywhere close to what we should be doing to help out here. Anyway, just my 3 cents. Okay,
And
thanks
then one
for that.
question that
Yep.
is going to came up, and it wasn't on your list of 4 things:
Yep.
oil prices. So a listener asked, are
Okay.
oil prices a good predictor of recessions?
I think they're that's a great point. I think in the current context, historically they have. Every recession we've experienced has featured a very significant in oil prices with good reason, because in times past we were very energy dependent.
Mhm.
The thinking is that now oil prices matter less because we've become more, almost completely energy or oil independent. But I would say in the current context, oil prices is the fulcrum with regard to whether we go into recession or not. Because, and this is from in my thinking, the thing that surprised me most about the Russian invasion and its impact, that the higher oil prices have fanned inflation expectations, and put the Fed in this very difficult spot. They're in DEFCON 1. And so if oil prices are say they're about $100 a barrel, roughly now, give or take on a given day, if they stay there for the rest of the year on average and kind of move south, next year, I think we get now apparently my baseline forecast, which is no recession. But if they go skyward, say for whatever reason, Europeans sanction Russian oil and we have to fill that void, the world has to fill that void, oil prices spike, I think we're going in. And that's how close we are to recession. So I think at this point in time, oil prices are very, very critical to, which path the global economy is going to go down. Any other views, any other perspectives on that?
No, I agree.
Okay.
So you're talking yourself up in recession odds.
Oh, no. This, I've been saying this all along, Ryan, as
All
you
right.
know. That's not
Oh, yeah,
fair.
you have.
Yeah, I've been saying that all along. Okay, anyway, I think I'm getting tired. I'm sure you guys are too. Thanks for coming, Michael. Chris, I know you got to catch a plane. Ryan,
Cheer up.
To say.
Cheer up, Ryan.
Just a realist.
all right.
Just a realist.
All right. Take care, everyone. Thank you for joining us this week. Talk to you next week.